So Jesse Thompson is our speaker today. He's a senior economist with the Federal Reserve Bank of Texas with the Houston branch. And his topic is really a regional economic update for us. I think he's going to present some really interesting information. I know he's not a stranger to the FENG. He's spoken before to the FENG's Houston Special Interest Group for Energy in the past. And so a number of our members have heard you speak before, and we're really excited to hear what you have to share with us today, Jesse. So I'm going to hand it over to you and remind you to unmute your mic.
Okay, then. Thanks, Brian, and thank you all at FENG for coming to see me in the morning. It's not always seeing an economist first thing in the morning before you're done with your first cup of coffee isn't exactly the top of everyone's to-do list, but I'll try to keep it engaging. And my talk, as always, I've especially this year, my wheelhouse has been more on the energy side. But Houston energy, then the state of Texas more broadly, are all my wheelhouses. So I'm happy to answer questions throughout and at the end. I'm really looking forward to that's usually the best part, especially with groups like y'all. Now, I do have to get a bit of two disclaimers. Number one, a bit of a warning, I am in blackout. Okay, so we are in FOMC blackout. It's a week away. So there's certain questions, I'm from the economics and economics background, so most of my answers to questions, while informative, are useless. Certain types of questions will be especially useless because I just have to tap dance around certain topics with regard to the FOMC. And apparently there's, I don't know if you've heard, there's an election. There are certain issues there we got to be careful about, but with respect to the economics, I can talk about it in a general sense. That being said, as always, my opinions are mine and mine alone, and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in any way, shape, or form. Now, going on to the slide deck, let me go ahead and share my screen. We're going to this one. Okie doke. So I'm going to start out very high altitude, okay, with some data that is publicly available as of a few weeks ago. And talk about what's going on in the world, because that sets the backdrop for what's going on in the local region, and what's happening in energy and these sort of unprecedented times. And I promise I won't say unprecedented more than a few times during the presentation. So Houston economic outlook. So the first thing we're going to get into here is, as a start again, very high altitude, economic backdrop, COVID-19 containment. So the virus is causing a lot of issues, obviously, in infections, deaths, and fear and uncertainty in many communities. But the effort to contain the virus, the policy measures to contain the virus, are where most, but certainly not all, where a lot of the economic pain is coming from, and how do we respond to the virus in terms of lockdowns and whatnot. But this estimated consumption growth outlook, there's a high degree of uncertainty still in any economic projections. The virus is very much still in the driver's seat. And if you look to my last bullet on this page, you'll see, oh yeah, by the way, a few weeks ago, we thought we were in a little bit better trend globally, but now, of course, if you've seen what's happened in Europe, there is many countries are experiencing a second wave and responding to that. Consensus economics forecast. So this is the aggregate of lots of different forecasters who focus on the global economy, and generally speaking, averaging lots of forecasters together is better than focusing on any particular one. Consensus economics forecast global GDP will contract 4.4% this year, 2020 versus 2019. That's the biggest drop since the Great Depression on a year-over-year basis. Next year, the average expectation is that the economy grows 4.9%. So that's a pretty strong growth, was the projection for next year. Again, this is a few weeks old now. But if you look at those projections and you say, well, I look at most of these forecasts and say, what are they projecting out? Well, not just next year, but the year after that, and the year after that, the year after that. It's several years before we get back to prior trend, to the where we would have been had we stayed on the pre-COVID trend and not had this COVID-19 recession. It takes as far as this the forecast horizon goes, it's not clear that this isn't a permanent shock. Like it's going to take several years to get back to where we would have been had we not had this shock. So putting that in, so that's sort of the global outlook. So again, we're going to get back to growth and growth rates, but we won't necessarily get back to the level we would have been at without this. On the US, focusing on the US economy, GDP was down 31.4% in the second quarter. The nice thing about that, all right, so this is the part of the dismal side. So, you know, a lot of economists were kind of were perversely relieved that we saw 31.4% GDP growth decline in GDP on an annualized basis in the second quarter, because it meant that our forecasts weren't especially terrible. It was right down the middle. Now the uncertainty band was wide. People were projecting everything from 20 to 40% decline in the second quarter, but you average them all together, it was about 32.5, and it came in just under 31, just under 32. That's pretty good. So what happens next? Again, most projections are saying that we're going to get back to growth next year on an annual basis and a Q4 over Q4 basis. The numbers I follow for the US are Blue Chip Consensus Economics forecast. And their forecast, I think, if you sail over the crisis, the Q4 of 2019 to Q4 2020, I think they were looking at a negative 3.3% GDP growth year over year in the fourth quarter for the United States. This is as of their October 10 publication. And then back to positive growth of, I think it was 2.5% for next year. So a little bit more muted recovery next year. But the United States did not experience as sharp a decline as many other developed countries. So it's not maybe so much of a surprise that our bounce back growth rate is a little bit slower than the national average. But still, the path of recovery remains highly uncertain, because what happens if we have a resurgence of the virus? In Europe, we've had a number of lockdowns reinstituted over the last several weeks. It spans the spectrum here. You've got, say, Ireland had a very harsh lockdown, which says you're sheltering in place, don't go more than 5 kilometers from your home. Whereas in other countries, the lockdown was more of the form of, all right, well, we're going to shut down bars and we're going to put a lid on the size of groups that can go out at night, curfews at 9 p.m. Local time, and it's not necessarily countrywide. Sometimes it's a city or a region. And so this round of lockdowns isn't necessarily going to be comparable, at least so far, to anything that we saw earlier in the year. And so the hit to the economy is going to be different. And remember, we're already, in many cases, operating like the FENG. We're remote for the foreseeable future. And so the delta isn't necessarily going to be as jarring for a lot of these countries that do reinstitute lockdowns. Just to put the data in pictures, here is information from our database of global economic indicators. As you can see, global GDP, and this is on the Dallas Fed website. You can see that I think the source there got cut off. Dallas Fed website. So you can see second quarter GDP growth globally was really down. This is year over year growth. This isn't annualized quarterly growth. This is year over year growth. And so you can see world was down 8.7% year over year in Q2. Advanced economies were a little bit worse. Emerging economies were a little bit better, and partly there was because the Chinese economy entered into this crisis earlier and they exited earlier, and that really boosted emerging economy numbers there, or helped out emerging economy numbers in the second quarter. But for non-economists who are looking for a one-stop shop to see, hey, what in the world is going on out there, particularly in countries where you don't necessarily trust the data, every month you can Google this Purchasing Managers Index. There's publications online with news releases where they tell you the number. If the number's above 50, it means growth in the service sector, or in this case, what's charted here, growth in the manufacturing sector. And generally speaking, for most economies, it looks like something between 45 and 50, it can be consistent with growth in the broader economy. But the main point is that this gives you a good sense of whether or not, say, in this case, manufacturing output is growing or contracting. And what you're looking at here is you can see, say, the light blue line, developed markets, or let me focus on the orange line here. The orange line, let me move my mouse over the thing. All right, the orange line right here. So that's emerging markets purchasing managers index. You can see right at the start of the year, the emerging markets dominated by China had entered into decline. China sort of leveled off a bit, but the rest of the world kind of caught the coronavirus. You see them weakening, but then they're first out, in part because of the strength of the Chinese economy. So this purchasing managers index, even though you might not necessarily trust the GDP data or have questions about official data from the government there, this purchasing managers index does a pretty good job of tracking overall economic activity. When you look at the blue line, developed economies, the light blue line here, sharp decline, sharp recovery. We're now back into growth. Growth from a low level. So we're not back to where we were in terms of output, but we're back to positive growth rates and manufacturing output globally. And just to bring it home for the Texas economy and for Houston in particular, most of this blue line here represents manufacturing output growth at the countries that we do the most waterborne trade with. So, and remember, what do we export in Texas? We export energy, plastic resins, machine parts, engines and other components for equipment. That's the bulk of what we put out on trade. We also do a fair amount of agriculture, but it's the intermediate goods are the bulk of what we export, and energy. And the manufacturing sector around the world is a good barometer for this global supply chains that are consuming the stuff we export. And so I put that in there to kind of bring it home on what these neat things mean for us here in Texas. And then you look down here at the, this is a weekly economic index that we publish on the Dallas Fed website. This is a proxy for US GDP growth. So if you want a really good indicator of what year over year GDP growth is looking like right now, this is about as good as it gets. You can see here, week ending October 24, it looks like negative 3.7%. Strong pace of recovery here as you come out of the bottom, or I should say the year over year growth rate is looking less bad fairly rapidly. But particularly if you look at the national employment data, it's clear that the pace of recovery is slowing down. All right. So GDP growth is bouncing back strongly. The pace of the job side of that equation is slowing down. And if you look at some other indicators, which I'm going to bring up in a minute, you'll see the slowing down in the pace of recovery as well. And this is going to get us cruising into somewhere around that. Like I said, if you think about where did the blue chip consensus economics forecast think we're going to end the year over year, they think we're going to end at negative 3.3%. So if we're already at negative 3.7 at this point, then there's not much left to go in terms of recovery rate. The recovery rate is slowing down to get from 3.7 to 3.3. Okay, so that's the high altitude economic backdrop that we're working with. Now I'm going to talk about Texas and the pandemic. So first off, Texas job growth is slower than the US since April, all right? Texas job growth slower. It's broad-based. The recovery since April has been broad-based. We did not decline on a percentage basis as far as the nation. You know, we're relatively resilient. But since then, our pace of recovery has been slower, and it's not too hard to see why when you look over on the right-hand side of this chart and you see oil and gas. And I'm going to remind you that in terms of employment, at least, and wages and royalties, a bit over half of the oil and gas industry is in Texas. So when we see these job numbers here, that's Texas there. The oil and gas industry is going to be a drag, or has been a drag, and will continue to be a drag on the pace of recovery going forward, but not as significantly as it has been here, as I'll get into later. The big moves that you saw were in leisure and hospitality. It's restaurants, and that's the sort of obtuse thing that economists call restaurants and bars and hotels. That's really where the bulk of that pain is coming from here. It's restaurants and bars are the big one. And we got a little bit of a setback in July with Texas kind of surging in COVID cases, and we had to shut down bars again and restrict. And we extended some of our restrictions on restaurants. But nonetheless, that's where the bulk of the pain was. That's where the bulk of the recovery has been. And until we can fully reopen, and we can talk about whether or not 75% capacity really matters versus 50% for a lot of restaurants. But this is where the bulk of the recovery has been. And until we can fully reopen, this is where the bulk of the pain is. That's not to say in terms of numbers of jobs, not total people or total pain, because we've also got a lot going on in the oil and gas sector and some others. We look at unemployment rates. Now, you can see when a crisis hits, unemployment rate goes up quickly. It peaks a little bit after, and then it takes a long time to come down. It peaked at the end of the recession, and then it took a long, steady decline from 2010 all the way through 2020 until it shot up. Now, when we get to this point here in the pandemic, unfortunately, comparing rates becomes tricky because the denominator here, and in some cases the numerator, but the denominator particularly, the labor force definitions had to kind of jockey with a little bit because of the nature of the pandemic and pandemic unemployment assistance. And so take these numbers here with a grain of salt when comparing them to history. The main takeaway when you look at these unemployment rates is, one, that they've been trending down. We had a bit of an uptick here in the Texas unemployment rate in September, but I don't really personally buy that because it doesn't really line up with a lot of other data that we've got. And so I think when the revisions, and yes, this data does get revised next year, when the revisions to the state data come through, I think that'll smooth out and we'll see a similar trajectory to what we see in the United States. Big increase, sharp initial decline that kind of levels out as we head in a little bit as we head into the fourth quarter. We still think this is going to decline, is going to see a bit of a decline here at the end of the year, but not much. And it will continue after this point as normal recessionary dynamics take over. Supposing that we don't have a resurgence of virus lockdowns, that decline rate will start to resemble more of historical decline rates, where it just takes a while for the job growth to eat away at the pool of people who are out of jobs.
Hey, Jesse, I have a real quick question on the unemployment rate. If there is a consensus, I think there probably is among economists, what's generally considered to be the range of unemployment rate and having full employment within the overall economy?
Excellent question. So full employment is kind of a moving target because there's a lot of different factors that can go into it depending on what you want to put into the model, right? So there's no, for example, true unemployment rate. But generally speaking, unemployment rate, we've arguably been at full employment. Unemployment below 5 or below 4%, that's definitely a full employment. I mean, the argument could have been made back in 2016 that we were at full employment based on historical norms. Now, the issue is, of course, when we think about the impact of our demographic shift towards a more aged population, what does that mean for potential unemployment with that? So many of us are now at a period of our lives where our attachment to the labor force is marginal. What does that mean for unemployment rate? What does it mean with all these technology shifts? What is the natural rate of unemployment, as we like to call it? Sort of what is just normal frictions of job changing and the propensity of anybody to be attached to the labor force at all. What does that mean for the unemployment rate? It's a moving target, but anywhere where we were, say, in the last 4 or 5 years, certainly the last 2 years, by anyone's definition is a full employment. But you could go back to even 2016 and say that was arguably full employment. So hopefully that answers your question, or at least gives you a sense of the uncertainty around that question.
Yes, Jesse, that was great. Thank you.
So, and then when you look at Texas restaurant reservations, so this is some of the high frequency data that people are looking at. It's leveled off. And a big part of this, of course, you can see the stay-at-home orders decimate the industry, absolutely devastate the industry. Nobody's reserving tables. You see things begin to open up in May and June. You see the COVID resurgence of locked up cases and the cancellation of a lot of bars, or the reshutting of bars in July hit the numbers. And then as we move through August, September, it's picked up. Moving from 50% occupancy to 75% permitted in restaurants and bars, for most restaurants, really isn't meaningful if you also have to maintain 6 foot distances between tables, between parties, and in terms of their capacity to actually just put more people in the room, it doesn't make that big of a difference. And just as an anecdote, we're hearing this from our survey contacts and board of directors around Texas. And then you look at, say, I went on vacation recently to Arkansas, and it was the same thing. They opened up to 2/3, and they said, well, that was great, but we can't really fit any more people in our restaurants while at 2/3 versus where we were at 1/3. Moving on to the pandemic. So there's a lot in this chart, and unfortunately it's hard to read, but I'm just going to give you the main part of that I'm going to focus on for today. Is you can read this at your leisure. Is the top half of the chart here. The top half of the chart shows the caseload, the virus load on the state. You can see an uptick earlier on, and then it kind of leveled off and was declining, but then in June, things really took off. We started seeing news reports at the Texas Medical Center in Dallas and elsewhere that we're running out of ICU space. We're going to have to go into our overflow space for COVID positive patients. And things got a little bit more serious there. And we reinstituted the lockdowns. And right about that time where we started rolling back some of these lockdowns in July, you see the red line, this red line, this number of hourly employees working, which you'll see that again in a minute, kind of tick down a little bit. COVID cases tend, it's not quite clear because of some of the data revisions, but COVID cases and hospitalizations in particular seem to lead deaths by about 2 weeks. And so you're looking at this chart here, this COVID-19 deaths, you can see the peak tends to lag hospitalizations, makes perfect sense. But as we move particularly into the second half of the year, treatments are getting better. The distribution of people who are getting sick seems to be shifting away from the older population to the younger population. So the population who's getting sick is healthier. So the relationship here is from infection to hospitalization to deaths, that it's shifting. So shouldn't expect nearly as many deaths. But what at the most recent data the last week is showing is that the orange line there, now 2 weeks after we saw the uptick in the green line, the orange line is starting to turn up again. Does this represent a trend? And does this mean that we're going to have to start reinstituting some type of lockdowns in Texas? Or what are we going to do? It's hard to say. Certainly you look at El Paso situation, or along the border of Texas where things have gotten worse, are driving a lot of those numbers. Moving right along. So that's Texas in the pandemic. That's kind of where we are. I really wish I could tell you that those numbers were all still trending down, but they aren't. And so there's some policy uncertainty here. I'm moonlight as the president of the Houston Economics Club, and we had the president of the American Medical Association on in August, at the end of August. And the consensus then, as reported by her, was that as long as everybody is keeping socially distant, washing their hands, yeah, sure, we got to keep bars kind of closed or limited. But if everybody is wearing masks, washing hands, doing all that, there's no reason we can't reopen. But we've got to get this virus under control, or keep it under control at some level, keep it at very least stable, if we're going to reopen the economy and get GDP and job growth back to where we want it to be. And from a local perspective, oil consumption back where we want it to be. So that's Texas in the pandemic. Brian, is there a comment or a question there?
I have a real quick question that came up. Just we're seeing your slides, which is great. Are you also going to make them available to be distributed after the meeting, so that
a PDF?
Okay.
Yes, a PDF will be available.
Perfect. Thank you.
So now zooming into Houston, let me look at the clock there. Zooming into Houston, your recovery is lagging the rest of the country, and it's no surprise. Now we saw a sharp decline early on, just like everybody else, but of course we're being weighed on by the oil and gas sector. Now what you're looking at in this chart, just to be clear, I've indexed the number of jobs. So this is total payroll employment, indexed to December 2014, so that all three of these lines fit on one chart nice and neat. The last oil bust gave us net zero job growth for 2 years. So that orange line there on the bottom, I'm pointing with my hand, not my mouse. That orange line here at the bottom is flat, and that is what the last oil bust did to us. We had a robust national economy, offsetting what was going on in the local economy's oil and gas sector. Then we started to get back on recovery just in time for Harvey. And just to point out, that number's been revised like 7 times as the better and better data have become available. And it's settled down here, but we marched right back onto growth. Texas joined us in growth and outpacing the nation right up to the last minute. And then we declined. And now you can see here the pace of growth in Houston. I personally think this is going to get revised to be a little bit more shallow. But the pace of growth kind of slowed down in Houston and Texas relative. And in both Houston, that's the orange line, and the blue line, the rest of Texas. So Texas excluding Houston. All right, so Houston's the mass of where the oil and gas sector is, but the rest of Texas was not immune to a lot of those effects, particularly out in West Texas. And then we're kind of back to growth here. We've recovered about 1/3 of the jobs that Houston lost in the pandemic. The United States has recovered about 48, 49%, and Texas overall has recovered about 46% of the jobs lost in the pandemic. But remember, our decline, the state's decline overall, was not as sharp as the country's decline. So again, the pace of recovery since we've been lagging, and I think energy is the main reason for that. But I told you the unemployment data was a little bit wonky, so I'm not going to give you a Houston unemployment rate, but I am going to tell you what's happening with initial claims for unemployment. And this is basic benefits, right? This doesn't include pandemic unemployment assistance or extended unemployment programs that have been new this year. This is just giving us a baseline sense of state programs. You see this initial surge of unemployment claims, you see it steadily declining, but the decline rate kind of levels off. You see the decline rate level off as you get over here. To where we're still in an elevated level. Normal levels are about 3.5 thousand claims on a monthly level, maybe a little bit less, maybe a little bit more, but that would be normal. So we are still definitely at elevated levels of claims, initial claims. And bear in mind, many of these claims at this point may be people who lost their jobs earlier in the pandemic, got unemployment benefits, got a job, lost their job, and are now back on unemployment benefits, or now at least back applying to. So this could be the same individuals in some cases. There's probably not too much of that, but that could be in there. When we look at number of hourly employees working, on home-based data. So home-based, for those of you who don't know, is this free software. It's utilized mostly by small businesses that helps you manage your payroll. So people clocking in, clocking out, particularly remotely, clocking in and clocking out. A number of businesses open, and this is a good sort of real-time measure we've found of labor utilization. And you can see here, I've indexed it to sort of January levels. And you look at Houston versus Texas versus the US, you see the sharp decline. United States saw a sharper decline than Texas did. You see us recovering very quickly. You see Texas kind of deal with the resurgence. And then you see these 2 bumps. I always like to point out these 2 bumps just to point out that people stay home when there's a shelter in place order for a hurricane. And so this is mostly impacts from Galveston and other sort of southern and Harris County, but counties that are affected by hurricanes in the Houston metropolitan area. So you see that kind of hit us there. But then, as we get out of that and we begin to reopen everything, Houston's kind of picking up the pace. We're sort of converging with the rest of the country in terms of this labor utilization. But the interesting thing here is that it's just plateauing. The recovery, we're not going back to January levels of utilization at this trend. We're plateauing, and this is where we think that you should look for, say, this high frequency sign that the growth rate is slowing down, the pace of recovery has slowed down. We've leveled off in the back half of the year. And until we get some fully reopened, this isn't going to pick up more, or is unlikely to. So again, the virus is in the driver's seat there, I think. So now then, zooming in to our energy. So that big old lockdown that we saw earlier in the year, you can see it. The black line here in particular is the total consumption of petroleum products as reported by the IEA. This is a 4-week moving average. I guess so the timing is a little off because of the moving average. But you see here the black line, total petroleum product consumption fell about 25%, 27%. If you're looking at, say, gasoline, it was closer to 45%. If you're looking at jet fuel, it was 70%. But consumption of fuels declined when people stopped moving. No surprise there. And then overall, you see the pace of recovery kind of picking up, mostly from gasoline and diesel. And this is the different pace of decline, the different scale of declines here across fuels, and then the different pace of recovery has really been a problem for refiners. And if you have questions about that, we can go into it. But you've seen the recovery kind of level off here. Mobility has leveled off, consumption has leveled off. Gasoline and diesel, month on month, we're still gaining, but the pace is slow. We're at about -9% year over year for gasoline and diesel consumption. Relative to where we were, back in 2019. Globally, we are still seeing a similar pace, and we think that we're about globally we're around 90% of year ago consumption based off of data and estimates for September. And we'll have to see whether or not this second round of COVID takes some of the steam out of that stride. But generally speaking, it's projected that recovery and consumption is going to be slow going, and it's through the end of next year. All right, so we don't get back to 2019 levels of consumption, whether you're looking at the IEA, the EIA, OPEC's own numbers, Goldman Sachs, JP Morgan, IHS, you name it. We don't get back to 2019 levels of total consumption until 2022. And some people think it might even be longer than that because of what's happening with jet fuel. Jet fuel is going to be a long road to recovery by most estimates. Now, we might actually technically get up above that if plastics and propane consumption in the emerging world outpaces us, because plastics consume a lot of natural gas liquids in these numbers. But when you look at the consensus of forecasts, this is a little dated here. So this is from September. It hasn't really changed much. This is here you can see we don't get back to 100 million barrels a day over the course in the course through 2021, which is the end of most people's forecasts. Oil prices as such are down. We've got a lot of inventory out there that's going to have to be burned off. We don't think we'll work through COVID inventories before 2022 at this point, maybe a little bit sooner, but it's going to take most of the year. And at that point, we'll still have, it looks like, a healthy amount of OPEC spare production capacity to absorb. So consumption demand has got to grow. We've got a lot of spare production capacity. We've got a lot of inventories. And the consensus is that, bear in mind, I'm about to give you an oil price forecast. So this is probably the least accurate thing I will say all day. But that's probably going to keep a lid on oil prices throughout the forecast horizon, throughout 2021. Keep it in the WTI in the $40 to $45 range next year, plus or minus, of course, as always with any oil price forecast, plus or minus $10, maybe more, depending on what happens with vaccines and hospital treatments and whatnot. But this is going to keep a lid on oil. The oil prices are expected to stay muted throughout the forecast horizon. We are at about $40 now. It's been oscillating around $40 in the region. Most companies' break-even prices for drilling new wells is about $48 on average. There's a lot of variance from company to company, from oil play to oil play, but about $48. And it's about $46 in the Permian Basin, which is where most of the activity is going to be. That being said, you can look at here, we are seeing an uptick in drilling and an uptick in completion. So frac crews have gone back to work completing oil. So there's work being done in the oil field. Companies are drilling to maintain production, to maintain cash flow. Wells being drilled right now and next month are probably all about production next year. They're not about production this year. And there's a lot of that is also maintaining leases and other covenants and obligations. You got to keep the cash flow coming in. But we're not going to expect a major uptick in drilling activity or the number of monthly wells completed from here throughout the forecast horizon, because oil prices are going to be below most companies' the average break even for drilling and completing new wells. The most efficient companies are going to be able to make it work, budgeting at $35 WTI or $40 WTI next year. But a lot of companies aren't going to be able to. And so we're just not going to expect to see a big uptick in drilling and completions. And with the theme of that last comment, of course, bankruptcies are on, in the oil patch, are on pace to rival 2016 in terms of number, which is impressive because the companies are bigger now and the debt loads are bigger. And so the total debt associated with these bankruptcies is bigger. And so we've moved now past this phase where oil field services are laid off. The E&P companies are laying people off now. And the main offices are where we're seeing job losses. The offices back here in Houston, white collar jobs, and we're also more white collar jobs, and we're seeing the bankruptcy cycle pick up. And so as bankruptcies pick through, we'll see some more job losses in the head offices here in Houston. Now, we might see, like we saw in September, if that number was real, we might see some E&P job growth in the region because we're closing offices in New Mexico and Oklahoma and in Colorado, not because the industry, anybody's doing any particularly better. We're bringing people home to the home office because after closing satellite offices. But when we look at Houston jobs, this is the mining sector for Houston, and a similar trend could be said in Texas because a lot of these job losses are in Houston. What I'm including here for mining related, as we all know in Houston and in Texas, the oil industry doesn't stop at the oil rig. So what's included in this selected mining relating jobs? All right, so I've got oil and gas extraction, that's E&P companies, oil field service companies, that's the support activities for mining. But we've also got fabricated metals, which isn't all oil and gas, but in Houston, it's mostly oil and gas. And certainly the growth rate and the volatility is driven by oil and gas. And then I've got agricultural construction and mining machinery manufacturing, which again, same story in Houston and to a lesser extent in Texas, but especially in Houston, is driven by the oil and gas sector. And when you look at these numbers all together, you can see the job declines tend to bottom out. And this is a stylized chart here showing you what oil busts look like. Okay. So this is the last oil bust, but this is fairly representative of what you expect in most oil busts. Price of oil drops, the rig count follows 3 months later, like clockwork. All right. Now, it might be a little bit early, might be a little bit later, but generally speaking, the US rig count follows oil prices by about 3 months. Whether you're talking about right now or you're talking about the 1980s. Once the price of oil bottoms out, the rig count tends to bottom out about 3 months later and then comes back to growth. And it grows slowly until we get to an equilibrium. And then we do the whole tango over again. Now, this particular situation was more severe. The COVID crisis is different. Maybe this time will be different in terms of the timing. But certainly April was the bottom for oil prices. And late July, early August was the bottom for the rig count. About 3 months later. So the relationship seems to be holding true. And I think we're going to be in a long, slow slog to rebuild a rig count to a level that is going to keep us, that's going to return us to any type of production growth. The jobs. When do our neighbors stop losing their jobs in Houston? Well, if you look at the past 7 oil busts, it takes about a year. Now, last time we did it in a little bit less than a year, we had a little bit stronger backdrop of global economy, but it takes about a year once the price of oil bottoms out for the jobs to bottom out in an oil bust. This isn't talking about, during normal expansionary periods and fluctuations of volatility, oil busts in particular. It takes about a year. And then it's a slow recovery. And so this is where we are now. We're entering into this phase where we had a little bit, again, this data is going to get revised, but now we've bottomed the job growth here. I don't think it's bottomed out. I don't think that uptick is real. We've got more bankruptcies and more job losses coming. They're in the mail. In many cases, they've already been announced, but they haven't been executed yet. That we're going to lay off so many thousand people, and some of those haven't hit the numbers yet. In some cases, this is coming because of bankruptcies. In some cases, people are pushing for retirements. But there are more job losses coming. And we think by the end of the first quarter, this number will have evened out and we'll be starting to get back. And we should at that point begin to expect to get back to growth. Maybe times are going to be different this time in the pandemic. But one other thing that's going on with this pandemic and what it's done to global consumption is it's thrown some other numbers into uncertainty. So what you're looking at here is chemical industry investment in Texas. And there's some quirks, as you'll notice that there's some things from 2019 that are still under construction in this data set from the ACC. Fair bet that got pushed to 2020. But a lot of chemical construction that has already broken ground is going to be completed. But in this environment, with now the trajectory of US production kind of uncertain, more uncertain than it was, and certainly less bullish than it was 6 months ago. And the context of this global pandemic, the things that have not broken ground may be delayed, may be canceled. And we're already seeing that in midstream. We're already seeing some projects getting canceled in midstream with Phillips 66. I think it was announced a cancellation of the release for the foreseeable future of some of their pipeline capacity. We've got plenty of pipeline capacity. We've got lots of chemical capacity. We're oversupplied in global refining capacity. If you haven't broken ground, it's probably getting delayed, and some of it may get canceled outright. It'll depend to see what the global market looks like once we see the post-pandemic world and how many of us are going to be driving. What's the home consumption going to look like? There's a lot of uncertainty there. And just to point out, and that's billions of dollars and hundreds, in many cases, thousands of construction jobs on the Gulf Coast that are going to be sensitive to that. When we look at exports, whether you're looking at volumes, values, you see the decline and you see things kind of rebounding already. Global trade is growing. We're not back to where we were, but our exports are growing in terms of volume and in terms of value. Volumes, we're near to where we were previous peak because we've just still got a lot of stuff coming out of the ground that no one here wants to consume. So we're exporting it. But we're not back to where we were yet. And that manufacturing index that shows you at the beginning is a good gauge, is a good proxy for global industrial production, which is a great proxy for, and is a good proxy for global exports, So as that gets back to growth, as we see this back to growth, global exports are picking up. Remember, what we export is intermediate goods. And so things are picking back up. But another line out here that's worth keeping track of is this Texas value of the dollar. So this is the trade weighted value of the Texas dollar. So you take the US dollar and you adjust it for those countries that Texas exports to. All right. And you get this exchange rate, this value of the dollar here. Note the right axis over here, it's inverted. It's upside down so that it lines up with what you should expect with regard to trade numbers. So here you go. When this number is going up, when this number's value is decreasing, so you see the line here upside down going up, that means that we are seeing a drop in the value of the dollar, or you could say that Texas exports are becoming more competitive. When you see this line coming down, it generally means that the value of the dollar is rising. Texas exports are becoming a little bit less competitive. And now everything got jarred by the what was going on in global trade. We got a negative shock here. Now you see this number coming up, or this, what you say, the Texas trade weighted value of the dollar falling. This is improving our export, our competitiveness on exports, at least at the margin. And we've done some analysis on DallasFed.org. You can see where this is also associated with manufacturing jobs in Texas, and in particularly export-oriented manufacturing jobs. So a worthwhile thing to keep track of under normal circumstances. Of course, things are a little bit jockeying around right now with what's going on with the pandemic. Real estate. How am I doing on time? All right, I'm going to have to hurry through this to make sure we get more questions. Real estate. It's been all over the headlines. Apparently, really low interest rates for mortgages makes people go get mortgages and be really willing to buy a new house if you still have a job. Single family permits, after plunging earlier on because we just weren't filing the paperwork, absolutely surged. Multifamily is holding steady. The construction sector is doing very well. New homes, I don't know what the exact growth rates are for new homes at the moment, but you know, our contacts around the area for Metro Study, John Burns, you name it, you know, they put out these press releases. They have these webinars that are great. They talk about, you know, just new home sales are doing really, really well. Demand for single family housing is doing well. You look at existing home sales, again, pandemic kind of hit the numbers. Number of listings actually fell sharply, and then that has absolutely rebounded. Some of that is pent up demand. People who wanted to sell earlier in the year decided to sell and couldn't because nobody was going to come to a home show during the pandemic and wander around your house, and maybe you didn't want them to, but that's rebounded, and certainly sales are up, and the median and average home selling price in the metropolitan area is up, partly because supplies are low, partly because demand is high from mortgage interest rates, and partly because at the upper end of the spectrum, there's been a bit of a shift in the makeup of homes that are included in the sample that determines the median. So the lower priced homes are falling out, more higher priced homes are in there, and also there's just a supply constraint issue, which we can talk about, the affordable housing issue in Houston if you have more questions on that. But vacancy rates, office vacancy rates were just beginning to come down, and of course they're up now, and who knows what the office market's going to look like over the next coming years with oil and gas losing people again, and lots of inventory, and now us all investing a lot of human capital, becoming good at working from home and doing things remotely. Industrial office space is the worst it's been, I think, since this century so far in the 21st century. But 7.4% vacancy rate. Demand for that is still good. Most of that is coming from warehousing. This is square footage under construction or delivered that's going to be leased up. But there is a lot of industrial space out there that is vacant, that's being built. With everyone working from home, warehouse spaces demand has been really strong. And what I'm hearing from the Port of Houston and from contacts down in the port area is that the e-commerce and a population and simple population growth is really driving a lot of demand for industrial space in the region. Not to mention, of course, there's other manufacturing going on, occupying some of that space.
Hey Jesse.
Yes, sir.
This is Mark. So Tim had a question here that he sent to the chat thing. Can you quantify? Maybe go back a slide. Can you quantify what home sales are doing well means? You know, are median prices up? How much? You know, any color that you can add to that?
Yeah. So if you look at the median price, sorry, go ahead.
No, that's it.
Okay. No, that's great. Good question. So in terms of thousands of dollars, homes are median home price. Again, this is for the metropolitan area, not city of Houston. Median home price is up from, let's see, we're at 265,000. I think that's up from about 252 earlier in the year. And you notice it's been, if you look at median prices and average prices have been trending up for a number of years now, since really, since the last oil bust, or since the shale boom kicked off. And then you see in 2013, the pace kind of slowed down. 2014 oil bust took some steam out of the stride, but it's been trending up. And a part of the increasing in the median and average price over this time frame has to do with a lack of supply. We're not building houses, adding new supply at the low end of the price range. We haven't in years, and that's part of the affordable housing crisis issue. It's not unique to Houston, but it's been putting upward pressure on prices all this time. Inventories have been in the 4-month range of listings for existing home sales that entire time. And so you've seen a bit of an upward trend in the median and average price of the homes sold, in part because we've had population growth that has been outpacing our supply growth. You put those two things together and you get rising average prices. And particularly since we haven't been supplying, the homes we have been supplying have been at the upper end of the price spectrum over this entire time frame. Now, home sales, what does a good number of home sales mean? So let me put you this. So we're at 8,859 homes sold last month on a seasonally adjusted basis. So that's a pretty strong number here. Is it on par? I think we're now technically well past our peak number of monthly homes sold that we saw back in the housing boom. That should not surprise anyone that we got there. We were already there a year or two ago. The reason we were already there is because we've been building houses and we have more people than ever. So of course, we're going to have, on a long enough timeline, more home sales than ever on a monthly basis. On a population adjusted basis, home sales have effectively been flat. So number of home sales per number of people who have jobs, according to the household survey, has actually been flat. And I don't have those numbers handy. I do calculate them on a semi-regular basis and put them in my newsletter from time to time. But that number has effectively been flat since about 2014. So home sales per person with a job has been effectively flat until we get this big check mark on the right-hand side of the chart here. And so by this metric, we have not gone back to the level of home sales that we saw in the housing boom. We have not passed that peak. Now, maybe that's because we were giving homes to people who didn't have jobs back in 2007, giving mortgages to people who didn't have jobs, but who knows? We're not in the boom. We're certainly not seeing a boom like we saw in 2007, 2006, but we are seeing healthy numbers on a population adjusted basis. It's up relative to the flat numbers that we saw in the last 5 years. Is that sufficient? All right. All right, well, trying to finish up here. So looking at leading economic indices that we publish on a regular basis, the Texas leading index, the Dallas Fed puts out, saw an uptick. Again, we're not back to prior levels, but it's back to growth. Take it with a grain of salt in the context of government mandated lockdowns, limits on capacity utilization of certain businesses, but it's telling us that we're back to job growth. The US leading index, same story. You see this, you see the crisis, and that's telling us that we're back to growth. The components of these indices in aggregate are not back to where they were, and that's sort of an ongoing theme here. Bringing it home to Houston. This orange line is the Houston Leading Economic Index, which I publish on my Houston Economic Indicators newsletter every month or so. And you can see the growth rates here versus the Houston Business Cycle Index. This is this is a coincident index of economic indicators for Houston. And this is our sort of best proxy for regional GDP growth. And it's a better proxy, I think, than actual metro GDP growth. But you see here the sharp decline. You see the initial recovery, and then pace of recovery slowing down. And you can see the same thing in this orange line, which is my leading index, which generally leads economic activity by about 3 to 4 months, and has a very strong predictive for forecasts. What I mostly use for forecasting Houston over the next 9 months. So moving right along here, plug that in. Unfortunately, in this crisis, the nature of the pandemic, normal forecasting tools kind of become almost useless because of the uncertainty and because you have these sudden shocks to the employment data from policy. And so we're having to use a different method. And the method that we're using doesn't work so well for Houston, but it works pretty well for the state of Texas and for the United States. And so for the state of Texas, what we're looking at here is you see sharp declines in jobs that occurred, and you see what are we forecasting going forward? Well, we're forecasting that the pace of recovery is gonna stay kind of leveled off at where we are. We expect job growth year over year to end at about negative 4.2%. Negative 4.2% December over December job growth this year. We haven't done a forecast for next year yet. The uncertainties are still too big, but we expect, notwithstanding resurgence of COVID, no assumptions about a vaccine, assuming that if to the extent that we need it, that there's more stimulus coming, that pace of recovery, that this will continue to improve throughout next year, but at a slow pace. Obviously, if there is no more stimulus this year, that's going to put a damper on some of these numbers. If COVID does resurge here and we see more lockdowns, that is going to put a dent in those numbers and things will look worse. If we see a vaccine get deployed and developed that's safe and effective, that's going to put upward risk on the numbers. Same thing for medical treatments that reduce the fatality rate amongst those who do need medical attention. All of these things are risks that are really hard to account for in the forecast. And I'll leave it at that. But let's focus on Q&A here as we move into the final minutes. And if necessary, I can stick around past time for those of you who want to stick around after at the end, who stick around further. Questions, more questions.
Okay, has anybody else got some questions out there? Jesse's certainly offering up his time. I think you can just unmute. Yeah, unmute your microphone and ask away. Let's see, Libby has sent a message through her to the chat thing saying, "Can you comment on the healthcare sector?"
Sure. So the healthcare sector. So when we went on lockdown, and we saw this earlier in the year, first with travel restrictions, taking a dent out of medical tourism, as it's called. And then also with the lockdowns and surging COVID cases and COVID protocols at hospitals, limiting their capacity to service non-emergent, non-COVID cases, which we may be getting back to that over, say, in El Paso and in South Texas. When we saw that, because we saw medical employment drop. Now, as we've reopened, as elective surgeries that were backlogged, that were scheduled earlier on, that came back on, were suddenly available, we've saw a surge in demand, and we've seen hospital employment pick back up for a lot of those cases. There are still a lot of pain in the ambulatory. So this is non-hospital medical employment growth because people aren't going to doctor's offices. They're not seeking medical attention in some cases, or they're waiting it out, or they're going to clinics to get tested or for COVID, and they're getting some of their other questions answered that way. And so there's still a lot of pain in the medical sector in terms of job growth, in terms of jobs. Now, as people become more comfortable with visiting their physicians, as we've become more familiar with protocols, like, okay, when I go to the doctor's office, right, they're going to take my temperature before I come inside. They're going to do a hand sanitizer, and just to make sure if I'm COVID, where do I need to go? That is going to begin to slowly put upward pressure on demand for services from that group. But that's until we can fully reopen, until this is fully handled, and until people become more comfortable with going to a medical setting. In many cases, some people aren't comfortable going to a medical setting because they know there are other people there who feeling sick, and they don't want to risk it, particularly those who, might have a number of comorbidities. So it's sort of a catch-22 in many cases for them, because they have many comorbidities that they need to get medical attention for, but they are worried about going to the doctor. As we kind of move through this, become more confident and used to these protocols and more familiar with the risks, that's going to come back, but it's a slow pace. I don't know how long until we get back to pre-COVID levels of hospital employment or hospital and medical revenue outside of COVID, because contrary to internet memes, COVID is not profitable for the medical industry. It's been a negative. So I think when we get back to, it's going to be a while before we get back to normal, but things are certainly better than they were at the height of the pandemic in Houston.
Great, thanks, Jesse. Let's see, Jeff Martini's got a question. You mentioned the mix of fuels being a challenge for refiners. Can you expand on that?
Sure. So when refiners put various types of crude oil or mixes of crude oil into their refineries, they produce a mix of products. The molecules that come in, they can be separated. Some of them can be kind of broken up a bit and changed, but for the most part, they make what they make. And so if you see a decline in diesel and gasoline consumption, say, for example, like we saw at the beginning of this pandemic that outpaces diesel consumption, suddenly I'm producing way too much. Even if I'm producing the right amount of diesel, I'm producing way too much gasoline because I can't just split it up. And so refiners did all the tricks that they had at their disposal to limit gasoline production, but there's only so much they can do, right? There's only so much capacity to change the yield that's coming out of the other end of the refinery, the mix of products. And so we saw inventories of gasoline surge. We had a little bit, and diesel was looking all right, but then you saw a fast recovery in gasoline and a slow recovery in diesel. And so what our refiners had to do is, all right, well, now we got to go the other way. We got to produce more gasoline at some point in order to keep the, we got to produce more gasoline without producing too much more diesel, because the entire time we're wrestling with gasoline and diesel, we're still producing about 10 to 11% of our yield was jet fuel, and jet fuel demand didn't go anywhere. And all that jet fuel was being dumped into the diesel inventories. And so you had huge inventories of gasoline built, huge inventories of diesel. We've worked off, relative to consumption, we've worked off a lot of the gasoline, but diesel inventories are still really high. And so you've got refiners, they can make a little bit of money maybe on gasoline in the current environment now, but they're losing money on diesel. Diesel cracks are terrible. And so you've had, say, for the last 6 months, because of this problem with the mix of fuels being produced relative to the mix of fuels being demanded, in these unprecedented times, I told you I'd say it a couple of times, and these unprecedented times, they've had effectively zero margin since June. Zero refiner margin, negative in many cases, in many weeks, negative refiner margins all in. And they're still paying $2 a barrel and to meet the renewable fuels mandates. So there's still these other costs in the sector. So refiners are really struggling right now in terms of profitability. There's still a lot of excess product inventories out there, and the lack of demand for jet fuel is going to continue to keep downward pressure on margins because this excess inventory of diesel that we're dumping the jet fuel into are going to continue to keep down pressure on margins. Refiners have very little incentive to increase utilization rates, and it's going to take a while. It's going to take some normal, or preferably in their case, colder winters to suck up some of this diesel, to suck up some of this heating oil, and it's going to take some good driving seasons. So we're going to be people back on the road, and I'm sorry, Houston, the refiners really need you to be parked on Highway 16, on I-10 and on 610 to drive that last barrel of demand so that they can get some margin.
Great, thanks, Jesse. So let's see, Rita's got a question here. Terrific presentation. Can you comment on the growth in jobs and housing in the Austin area with new high-profile employers that have come into the area recently?
So I don't know the Austin numbers off the top of my head, but we do have a monthly newsletter. So the Austin we do have a monthly indicator, not the Austin Economic Indicators. We don't have that, but where the San Antonio and the Texas indicators will bring that up. And I can talk about the Austin numbers tend to be really volatile, and some of the subsectors, because the sample size is small, they can be really noisy, and it's hard to trace what's going on at subsector level. But Austin employment has been growing with Austin population and Austin traffic congestion. And just a feather in your cap, according to Texas A&M, total economic cost of congestion as a share of the regional economic footprint, Austin, you're worse than Houston. So congratulations. But the high-profile jobs that are coming in, so these are high-wage jobs. They're going to put upward pressure on the total jobs growth, but they're still, as far as I understand it, not big numbers. And so they're not the tens of thousands or hundreds of thousands of jobs. They're in the thousands to tens of thousands of jobs for many of these things. And so that's going to show up in terms of high-wage job growth for some of these technology sectors. We'll see what Tesla puts in place with the truck factory and the batteries and all this stuff going on. But it certainly is a positive story. What it means for housing prices, real estate market there, what it means is, the geography of Austin hasn't changed. And so the housing situation there is going to continue to be strained. Home prices are still going to be, I think, going to be very strong because the affordability issue is still going to be an issue there, simply because building homes, there's going to be more homes built, there's going to be more communities developed out there. But it's becoming more and more challenging as we kind of move farther out, as the traffic congestion puts a tax on people's willingness to move further and further from city center and from employment centers. But I'll leave it at that because I kind of at the limit of my knowledge on the Austin real estate scene there. Suffice to say that the market remains very strong, and this is only going to keep it tight, keep that market tight.
Okay.
By this, I mean the new companies coming in.
Thanks. So there's another question out there, but I've got a question I think that might go along with that. And things are rumbling around in my brain. We're hearing this different stuff of, how we've kind of come back across the country and all that. What would, maybe you guys have seen, or you guys have projected some numbers, that what would it have looked like if the other areas of the country, mainly the Northeast, look at Michigan, Illinois, and California, look at just those areas alone, if they had opened up their economies to the extent that some of the others have. What would the numbers have been like with that? Because we see a lot of these things are still depressed because significant parts of the country are still and have remained in somewhat lockdown, some more than others, but certainly much more than, Texas has and, Georgia, Florida, and some of those areas. What impact, what would the numbers have looked like if everybody had kind of opened up similarly?
Well, obviously, there's two things that I can say about what that would do, because making a counterfactual is always hard. Because while policy is a huge thing, remember, mobility declined before the lockdowns. People, and this sort of, so, individual people are not irrational, right? They respond to incentives. And when people saw the COVID cases rising, particularly in the beginning when there was a lot of uncertainty, you see hospitalizations rising, you see the death count rising. A lot of people, particularly at-risk populations, say, wait a minute, I don't want to go out anymore, or I don't want to go do this thing. And so you saw a retrenchment. Even in countries and areas that you didn't have lockdowns, you saw individuals change their behavior. All right. Now, the lockdowns were a clear breaking point that drove a lot of the activity. So it wouldn't have been, so no lockdown in the presence of the virus, or, you might have seen a resurgence of the virus. You still wouldn't have gotten back to pre-COVID levels. Now, we would have had more economic activity. More people would have been going to restaurants and bars. More people would have been going out and being mobile and going to movies and things like that. But it wouldn't have been like nothing was going on. People would have still restrained themselves in the face, to some extent, in the face of COVID-19, based on what we saw in areas that didn't have lockdowns, or that had, in countries that didn't have lockdowns. Now, when we say California versus New York and the Northeast, whatever, the reopening, it's tough to take a national average here, because, while you might make the case that Europe is entering into its second wave, a lot of people talked about the US second wave over the summer, but there really wasn't the second wave. It was the first wave hitting different parts of the country at different times, in part because of the lockdowns, in part because of differences in population density and in demographics. Some parts of the country are demographically older. Texas is a young state with a low population density. Now, we do have a lot of poverty relative to some states, and a lot of minority populations with a number of comorbidities that make it worse. And so you have multiple generational households in some communities that are higher percentages, but generally speaking, lower density and a younger population made Texas look different than other states, along with the fact that we also went ahead with a national lockdown in April. And so our first wave hit us in April, came to California later, came to Arizona later, but the Northeast was kind of first, in part because they had all the right ingredients for the virus to take off early on, including a lot of international travel relative to other parts of the country. So it's hard to say, if they had reopened, well, number one, would they have reopened, because what would the population's response have been in that environment? Because they probably would have seen a worse COVID result as a result of those factors, such as population density. What would the population's own response have been in the absence of policy lockdowns? That's an open question, but it's suffice to say, it wouldn't have been nothing. They wouldn't have acted as if nothing was going on. So the recovery thus far probably would have been stronger. It's not clear how much stronger it would have been, because based on what we're seeing right now, it's clear that had we more of the country reopened earlier, COVID numbers would have been higher.
Okay, and this kind of goes along with this question. So Chad's got a question of, what is the general view from economists, you and others, on how elections impact the numbers and forecasts that you have shown? And is this election different in any way than what we've seen historically?
Well, is this election different? It certainly seems different on a lot of vectors, but in terms of economically, obviously, certain sectors you're going to worry about. So what does a Biden administration, a change to a Biden administration, if he were to win, if the Democrats were to win, what does that mean for the oil and gas sector, would be the most pertinent question to our region, to Houston. And along with that is what assumptions are we making about what happens to the House and what happens to the Senate in terms of their capacity to pass laws or change regulations. Now, it's not clear exactly how far they would be able to go. Certainly, I would say that based on my conversations with industry, they're concerned. In the immediate future, what does it mean for us? The election? Well, it means, for one thing, not as much as people might think. First off, the uncertainty here has driven a lot of companies who have acreage on, or who want to drill on federal lands, to rush to get permits. And once they have those permits in hand, they can use, it becomes suddenly legal. The legal barriers to stopping them are much more, are harder to the legal hurdles to stopping them are higher. All right. Now you can stop issuing new permits, but permits already issued, that's a different story. Another thing to think about there is that the bigger issue for most oil and gas companies over the next 18 months isn't who's president of the United States. It's the next $5 per barrel of oil price that they can get. Does the consumer come back? That's a bigger deal for the next 18 months. If the consumer can come back and we can get a higher oil price, that revenue is everything. Now you start thinking longer term, you start thinking 2022, 2023, 2024, 2025. That's where the change in administration on a longer timeline, regulatory limitations on drilling and permit activity, where that could become a problem. In the meantime, on its own, at least the executive office doesn't have a lot of capacity to do much besides say no more drilling permits on federal lands. Offshore, you talk about ANWR, you talk about East Coast, and some of the, Obama said we're not going to drill there. Oh, Trump said, yes, we are going to drill there. We can barely get funded in the next year and a half to drill in the Permian Basin. They're not going to do a greenfield, some development in some random place, right? So they're going to focus on the plots that we're already drilling, where there's already infrastructure, where the rate of return is not farther out, and so there's election risk. There's multiple election risks from a policy standpoint of going into some of the federal lands that they're talking about taking off the table. So I'm not too worried about this election. Near term, longer term, from an oil and gas standpoint, what does it mean? We'll have to see what happens in terms of green policies. Do we get a carbon tax, et cetera, et cetera. Other factors, though, there you could see trade barriers are generally poor for the oil and gas sector. We like to see, because the biggest factor driving hydrocarbon consumption growth over the next 40 years, over the next 10 years, is plastics. And we make and export a lot of plastic.
Jesse, quick question about the permits. If the companies are rushing now to get permits, how long they are valid normally? 4 years, 5 years?
Well, in some cases it's 10 years. Where they act on federal lands. It depends. I think, say, if you're talking about like New Mexico, which that's what everyone's really talking about, is New Mexico for the most part. Colorado as well, but New Mexico is really the point. I think it's at least 5 years that they've got access to that permit to drill. And should they run out, they can shift their drilling schedule to those permits in the meantime. And when those permits run out, they can shift their drilling schedule to private and state land, which local governments are still permitted, don't show any sign of limiting. Now, there are signs that states are going to clamp down regulatory wise on, say, flaring, which they ought to, in my view. But yeah, no, the state and fed, most of this production growth and most of current production and current sites to drill are on state and private land. They're not on federal land. So there's still plenty of resources to drill out.
Okay. Tony's got a couple of questions here. He says he's got a friend who's a crane operator, recently started a 10-year maintenance contract with a chemical plant. His projects have been pushed back. His hours are down to 32 hours a week. He's not even going to the plant. His crane company has to absorb the downtime. It says it's consistent with your presentation. With housing construction increasing, should this also drive demand for these chemicals?
Yes. So obviously, and it depends on how we do it, right? So and it looks like it's what people want is to have an extra bedroom so that they can have a home office. So if you're building new communities, right, that absolutely puts upward pressure on demand for polyethylene and polyvinyl chloride in particular. So polyethylene, think plastic bottles and filling and pipe, particularly upper price homes now. Are you seeing a lot of demand for PEX, which is a flexible piping that you can put in and it can be colored. You can even do like undercarriage lighting and other crazy things for your plumbing section with this stuff. And so there's very, very cool things going on there. But a big part of it is new developments when they first go in to do the land development, where they're doing the grading, they're building up the homes, they're plotting everything out, and they put in the municipal pipe. That sucks up huge volumes, these wide diameter utility pipes for sewer and water and all these other things that are made out of mostly polyvinyl chloride, but also polyethylene. That demand puts upward pressure. And of course, if you're putting in a new home, you've got wire coatings, plates for your switches and outlets, you name it. There's all kinds of stuff going on in there, and appliances, of course, as well. It does put upward pressure on demand. And remember, regardless of what happens in terms of housing demand policy shifts here in the near term, what does COVID mean? What does it not mean? There's still there's still nearly 1 billion people joining the middle class over the next 30 years who are going to be buying a lot more plastic. So the demand is coming. If you look at these Exxon and BP, and read between the lines of the BP one, but Exxon, you look at all these numbers, demand to 2040, demand to 2050, almost all the demand growth over the next 30 years is plastics. So plastic demand isn't going anywhere, though it might change its form depending on regulation.
Good. Tony's got another question here. The stock market appears to be disconnected to the economy. GDP down 4% and growth is slowing down. Do you see a swoon in the stock market in the near term?
Never ask an economist for stock market advice. We're incredibly boring people. We mostly invest in what is it? First off, legally avoid taxes and legally avoid fees, and after that, just keep it diverse. That's all we do. We're boring. The stock market, the disconnect there. I don't know if we should expect a correction or not. Certainly the data at this point does not suggest that the monetary policy, and I need to be careful here. There's certainly I would not expect from say the cost of credit at this point, the outlook. If you look at what the Fed put out in September. And sort of the economic data that's come out since then, it doesn't look like it's going to be a while before we get back to pre-pandemic levels of accommodation. All data dependent, but based on at least what we saw in September. But what happens with, say, Treasury? What happens with with Treasury, with debt, with their backing of some of these loan programs? What happens if there is no stimulus package? That's the big one. What happens if we get no stimulus package? I was on a roundtable discussion with small businesses in mid-October when the tweet came out that they were going to push the discussions on another aid package back past the election and maybe not until next year. And the businesses there like palpably whitened, like their faces whitened. They got worried because for a lot of companies, they are just barely hanging on. And as long as they can't be open, the stimulus packages are the only things keeping them open and keeping their employees on the payroll. And so regardless of whether or not they're following the rules on the PPP loan they got, this money is the thing that's keeping them in business. So that's a lot of concern there. I think fiscal policy is an area where, when you think about stock market, when you think about aggregate demand, performance of businesses, particularly small businesses, where fiscal policy has a lot of room to directly affect the outcome of the economy. And I think you'll see that you could see that spill over into the stock market. But there's still, another thing going on in the stock market, remember, is, a search for yield, a search for, a willingness to take on more risk globally. This isn't just a US phenomenon. Global flow of funds into the stock market, are being moved by this thing. And so I think that's part of the disconnect here, just like we saw back in the last financial crisis, where, there's just a lot of money looking for somewhere to go, and the stock market was a place where you could at least get some yield. Theoretically, that can't go on forever. We're at 9 o'clock here.
It is 9 o'clock. I know. Libby's got a question here, and then I think we're going to probably have to get up. Unless Charlotte, are you able to keep the meeting going? If Jesse wants to answer some more questions.
Yes.
Okay. Well, Libby's got a question here. Can you comment on the education sector and the impact to the Houston economy?
On the education sector. So obviously, when everyone went home, that jockeyed with the numbers here, it's definitely been a negative. We lost a lot of jobs in education, particularly private schools, and where you had COVID protocols that you suddenly you didn't need as many people. You had one teacher taking on too many jobs, taking on more students in an online environment. It's hard to say what this is going to do in terms of the pandemic. Once kids get back in school, obviously the demand is going to be there. And once they're back in school, that frees up a lot of people to be able to go back out and to get a job outside of the home to the extent that they're able. Longer term, education, it's not an exaggeration to say that education is everything. And are our schools producing not just an educated workforce, but a dynamic enough workforce with regard to the skills that they acquire over time to go out there and work? And it's not clear, it's, to the extent that Houston is succeeding relative to other major metropolitan areas. But certainly education is a challenge. We have a high rate of individuals not graduating from school, not graduating from high school relative to other parts of the country. Houston ISD has been on a roller coaster organizationally. And that's the largest school district in the area. And if we don't get the education piece fixed, that's definitely going to put a damper on long run growth. It's going to put a damper on our capacity to attract. Low taxes and low cost of living will only get us so far in terms of attracting talent from outside the region. We need to be organically developing our own workforce in a manner that is up to the 21st century challenges. Just to put the point to bed, if you look at the last 30 years of wage growth, the last 30 years of economic growth, all of that growth, it's a bit of an exaggeration to say, so forgive me some averages here. All of the economic growth and wage growth in real terms over the last since late 70s, mid 70s, accrued to the skilled. And you can slice that term a lot of different ways in the surveys, but all of it accrued to those who had some manner of education, trades, you name it. That's where the job growth occurred. If you didn't have a high school diploma, if you didn't have some college or some type of trade certification, on average, your wages in real dollar terms for the last 40 years have been stagnant or declining, except in those cases, and except in those periods where we expanded transfer payments and welfare benefits. Now, forgive a little bit of averaging there, but if Houston's economy, any part of our region's economy is going to grow, we have to grow our inventory of skills. skilled individuals who are dynamic enough for the economy that we're having. We've been very fortunate to be able to attract a lot of talent to the region. But in order to really unlock our potential longer term, we've got to do a little bit better on our educational outcomes.
Okay, well, we appreciate that and everything. For those who want to stay, Charlotte will keep the meeting open for a little bit for some more questions. Let me wrap up with a few administrative items we can. First off, Jesse, thank you very, very much. We really appreciate your presentation in that. And like you said earlier, we can send out the slide deck later today or tomorrow. So thanks for a great presentation. I think I've gotten a lot of comments on the chat room over here that everyone's really appreciating that. A thank you to Charlotte for keeping us going and organized her via Zoom here for the last several months and everything. A couple of reminders. December 10th, we're going to have our holiday get-together, a happy hour at Escalante's in Hughes Landing. Again, that's an unofficial event with just us going there. It won't be on the FENG website and everything. We'll try to send out some emails from us personally to remind people that we have that. We also, our next meeting for the FENG Woodlands will be on January 27th of 2021. We can't wait till 2021 gets here. We can get this one behind us. Again, that's in the Hughes Landing area. It starts at 7:15, and hopefully we will have that in person, but we'll be updating everybody certainly on the website with that. Last, everyone certainly have a safe and happy Thanksgiving. We hope to see you at the holiday event in December at Escalante's. I'm going to step out of the meeting and everything, but Charlotte will keep things going for anyone who wants to stay in and ask some questions of Jesse. Have a great rest of the day, everybody.